for joining in. Shibani, Sircar, Kurian, Senior EVP and Head of Equity Research at Kotak Mahindra AMC is with us on the show now. Shibani, afternoon. India's outperformance resilience is getting tested in today's fall. So we've seen quite a decline in the Indian equity markets, and it's broad-based selling. There's literally no space sector theme which has been spared. Do you think markets are in for a bit of a correction? We could, see a little more of a decline from here on, considering our outperformance. We could align ourselves with global markets.
Hi, good afternoon, and thank you for having me on the show. So if you look at Indian markets into two parts, one, if you look at from a fundamental basis, our growth, both in terms of macro as well as earnings, continues to remain fairly stable and robust. And corporate earnings profile has been holding up for a fairly long period of time. And that has been one of the drivers for markets, apart from flows. But however, the other second aspect of markets, which we've been highlighting for a while, is the valuation aspect. Our markets have clearly been one of the best performing markets, and that outperformance has meant that India on a relative basis is trading at premium valuations, which are above long-term averages. If you just look at absolute valuations as well, Nifty is now trading above its long-term average multiples on a price to earnings basis. So whether you look at it on price to book, yield gap, any of these parameters, valuations are looking somewhat stretched. Now within the market construct, if you look at large cap, mid cap and small cap, our belief is at this point in time, mid and small cap valuations are appearing stretched on a relative basis, specifically to the large caps. So therefore, if you look at the mid cap valuation premium on a 1 year forward price to earnings vis-a-vis the Nifty, for instance, that number is significantly above its 10-year average multiples. And similarly, the small cap premium or discount to in terms of price to earnings to the Nifty has also narrowed considerably. So therefore, from an absolute basis as well as on a relative basis, we do believe that valuations, especially in the near term, especially where mid and small caps are concerned, are looking somewhat stretched vis-a-vis large caps. And therefore, we believe that at this point in time, given the kind of volatility that could be expected in the near term, large caps are better placed in the market.
Right. You're absolutely right. You guys at Kotak were, you sounded out the caution on broader markets, I think the first, you and others that we've been speaking with from the Kotak platform. But I think a lot of the sell side has now followed suit. I think that Kotak institutional equities known on the other side, they came out with a report, I think, which was widely read. And more and more we are hearing that kind of...
Cap dash, you remember?
That's uncharitable.
But that's what they called it.
Okay, but Shibani, so then look at large caps, right? That's the whole point, and where things are a little more reasonable. But let's just talk about banks, for example, right? And I think when we talk banks, I think it all comes back to HDFC Bank and what's happening and what's likely to happen, etc. But what about names like IndusInd Bank, etc.? You think it makes sense to kind of look at banks down the curve, which have consolidated for a long period of time, have not done very much. Business momentum generally seems to be pretty strong.
Yeah, Prashant. So when you look at the banking sector and what's really happened, say if you look at calendar year to date, we will clearly see two parts of the sector. So one is the larger private banks, which have not participated in the market movement at all, while you have the public sector banking space and some of the old generation private sector banks and even some of the NBFCs, which have clearly participated in the overall market up move. Now, where the banking sector is concerned, and specifically some of the larger private banks, the two key concerns which are there at this point in time, one, that loan growth will slow down, and second is the trajectory on margins. Now, if you look at data on loan growth has actually been holding up much better than what was anticipated at a system level. And some of the larger private banks will possibly grow ahead of a system, and therefore that market share shift in terms of loan growth would continue. Now, margins have clearly peaked out, and they possibly peaked out in the fourth quarter of last financial year. And therefore, there will be some pressure on margins going ahead over the next few quarters. However, if you look at from an earnings perspective, banks have a lot of cushion, especially where credit costs are concerned, and maybe to some extent in a few cases where operating expenses are also concerned. And therefore, the earnings impact because of margins coming off is not likely to be significant. And therefore, what we really believe is if you look at the larger private banking pack, where we have seen significant ROE expansion over the last couple of years, multiples are looking fairly attractive. And therefore, within the large cap bucket that you were talking about, this is one sector or segment which looks attractive, both from fundamental as well as valuation perspective.
Okay, all right. Shibani, just hold that thought. As we speak, the markets actually are taking a swing down for the worse, actually, because we have ITC that's moved to the low point of the day. NTPC as well has seen some bit of selling pressure. And Grasim, just pull up the intraday chart of some of these stocks. Some of this fall could actually be expiry related, but the bears clearly are on top as we speak. And in the final hour, if you're hoping for a short covering, well, that's a hope at least as of now, because it appears the selling pressure is intensifying and the stop losses actually are getting triggered, the 19,550 odd mark. Well, Shibani, you spoke about, the banking sector earnings. Do you think the markets have taken for granted that we'll see 15% earnings for the next couple of years for the Nifty EPS itself? And that actually could be at risk, given the, crude oil prices have spiked up and some slowdown as well we're seeing globally.
Yeah, you're right. Absolutely, Nigel. That I think for the markets at this point in time, if you look at valuations are clearly factoring in fairly strong earnings growth, which is in the mid to high teens for FY24 and FY25. As of now, till the last quarter, earnings has been holding up fairly well, and there has not been any earnings disappointment. From a demand perspective, and if you look at the overall construct of earnings are likely to be now driven more by margins rather than the top line growth. And therefore, that's what we've seen in the last few quarters, where margins have been now the driver for earnings for corporate India. And in that context, if there is a sustained increase, for instance, in terms of crude oil prices, or if input cost pressures start to factor in, then therefore we would have to then revisit earnings. So going into this earnings season, which is going to come up, which is the second quarter numbers, a few key factors that we will watch out for. One is in terms of the top line or in terms of demand environment. The bottom of the pyramid, rural demand recovery, that is something that we will have to keep a close watch on, whether that comes through, especially during the festive season, and what's management commentary. And secondly, the outlook on margins. So yes, as of now, I think one risk that we would have to keep a close watch on would be the trajectory of earnings. Having said that, I think corporate earnings or corporate India in terms of both balance sheet, cash flows, as well as return ratios seem to be very well placed, because over the last few years, we've seen return on equity as well as cash flows improving for corporate India, and leverage has gone down. So from that perspective, corporate balance sheets are fairly strong.
Shibani, out of time. Thank you very much for joining in and providing that insight on the market. We'll slip into a break. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also tell you what you can buy today to sell tomorrow. Calls from our experts.